Hey everybody, welcome back. Another video today. We will be looking at Tesla. Now, Tesla has been exploding over the past month and a half ish, mostly because of Elon Musk's new relationship with the government being seen as very, very favorable for him and his company. People are expecting massive things from the company within the next few years. One major announcement I've seen recently is that robo taxis will be coming soon, which is completely autonomous taxis. So, a lot of big things happening for the company. I'm going to go through a full review, see what's actually going on with things like their financials, their recent earnings report, and I'll look into their stock chart as well for some technical side things. But overall, going through the company. So, if you're interested, make sure to subscribe. I do videos like this on all different kinds of companies every single day. Comment any companies you want me to review personally, and I will make sure to get to them as fast as I can. I get a lot, I do a lot. Let's get into Tesla. So, obviously, I think everybody knows what Tesla is, but let's get into some industry metrics right off the bat. So, first of all, it looks like deliveries are actually supposed to decline over the next year, going from what I believe is 1.8 million to 1 point just under 1.8 million at 1.79. So, that is something to take into consideration. Their deliveries are projected to drop in 2024 by the end of the year. Gross margin looks like it'll basically be staying steady, a little bit lower than the beginning of the year. Delivery units for the specific models, you can see Model S will be increasing slightly, Model X will be decreasing, and Model 3 will also be decreasing. So the average selling price of the Model S is also decreasing fairly significantly, going from 92,000 in 2023 to 77,000 by the end of 2024. So that is also very significant. So overall, their car sales are declining mostly across the board. Another thing to look at for Tesla is they are at a 1.4, almost 1.5 trillion market cap. So that is definitely something to watch out for. I do believe that they are fairly significantly overvalued at the moment. I really don't think they have much more room to expand off of their current price without some very, very significant growth. Other than that, cost of capital here is right about in line with the average at 11.3%. The average rating is a hold. Target price is at 290, which again, if you look, we are at 473 right now, way above that target price. And also the long-term growth rate is at a fairly decent 8.5%, which is fairly good. So let's get into their growth summary. You can see here, very, very positive across the board, other than with the 1 year EBIT, but that is nothing to be concerned about. So, sales growth is projected to grow by 47% yearly over the next 10 years, which is insane. Same thing with the EBITDA coming in at 77% growth rate. That is crazy. Even their net income is expected to double or more in the next few years, EPS as well. And then book value per share is expected to massively grow over the next 10 years, which is fantastic. Very, very positive things for the company. So now let's get into some of their financial statements and we'll go over some of the more specific things with the company. So going through their income statement, you can see Tesla is projected to have record sales for 2024, coming in slightly over where they were last year. But some things to note with that, their operating income is lower. Their net income is also lower. So again, despite the higher sales, their margins are decreasing. So that's definitely something to pay attention to. Another thing, it looks like their total shares is also increasing along with that, which is not great, but obviously it's not a massive amount considering how many shares they have. That's nothing too worrying. And that's about it for their income statement. Obviously, their EBIT is going to be actually their EBITDA is very, very slightly lower, not as much as everything else. So nothing too bad there. But overall, the income statement looks good with record sales. For their balance sheet, it looks like their cash is very, very solid. They really don't have a lot of debt compared to how much cash they have, which is fantastic. They obviously have a ton of room for expansion that they can do with how much cash they have, possibly some acquisitions or something like that. Definitely a lot more development. But overall, total assets are skyrocketing. You could see in 2023 going from 82 billion to over 106 billion. We could actually get a little bit more specific here and go into the last few quarters to really see what they've been up to recently. And we could see record assets over the last quarter, record cash, massive amounts of cash, actually. Their long term debt barely increased. They do have a little bit, but nothing that's really considerable. And obviously, with their retained earnings, they have $32 billion in retained earnings, which is fantastic for the company. So, moving into their cash flow statement, we will see here they obviously have very, very good funds from operations. They do get a lot of it from depreciation, but that's no big deal as long as their funds from operations are putting them in the positive. That is good. For their investing activities, you could see it's mostly capital expenditures. They did sell off some investments this year or in the past quarter, but that's really nothing major. And then in terms of their capital stock, you could see they have been actually selling stock over the past 3 quarters, which is definitely something significant. A little bit mixed on the debt side, mostly issuing more than paying off. But again, their debt is very manageable, so nothing too worrying there. Um, 2 quarters ago, they actually saw a negative free cash flow, which isn't exactly great considering how long they've been positive. But over the past 2 quarters following that, you can see they are very, very positive and actually have a fairly recent high going all the way back to September 2022 with 2.7 billion in positive free cash flow. So overall, that looks pretty good. Onto their use of cash, we kind of already covered this, but again, they have been issuing a little bit more than they've been paying off in the past year, which isn't too bad. Again, stating how manageable their debt is with how much cash they have, so nothing major there. And then again, they have been issuing equity over the past 3 quarters, not really repurchasing any significant amount other than here, where it basically canceled out the last 2 quarters. But overall, cash flow is looking good. Heading into their ratios, this is really where a lot of important things for their companies come from. So overall, it looks like we can head into the quarters and get a little bit of a better picture there. So gross margin is at a 3-quarter high, highest it has been in 2024, which is good. Overall, though, lower than where it used to be a few years ago in the upper 20s and right around the 20% range. Now we're at 18.2, which could be bad. Net margin looks all right at 13%. However, it used to be around 14 to 15%. But again, with the sales growth, it is mostly okay as long as their sales growth can outpace their net margin decline. So overall, nothing too bad here. ROA and ROE are declining, as you could see, going from an average of around 15 down to just under 12 now. And then same thing with return on equity, averaging downwards fairly significantly. Actually, it used to be at 30 and now it is just above 20. So definitely something to pay attention to there. Again, this also comes from the massive increase in the stock price where they genuinely just do not have much more room to go up. So that is just definitely something to consider with this company because of how much they are worth. And again, with their debt to equity ratio, very, very manageable, just under 14%. This is very, very good for any company of any industry. Usually you want it to be below 80%, which I say this all the time. 80% long-term debt total equity is considered healthy. So the fact that they have it at under 14% is fantastic. That is very good. So nothing to complain about on that part. So now let's get into some more specific things with them. This is from their last earnings report, October 23rd. So you can see their automotive revenue missed slightly on the estimate. Their sales and credits also missed slightly. Looks like leasing missed. Energy generation, again, missed estimates. Services beat slightly on estimates from 2.6 to just under 2.8. Gross margin beat, automotive margin beat. Looks like their margins actually beat across the board with everything here, including services where they're at 8.8% versus the 6% estimate. EBITDA margin beat significantly, 3% over the estimate. Cash from operations grew very significantly. Capital expenditures came in $1 billion above estimates, however, which is definitely something very significant. And then free cash flow on top of that came in well over $1 billion above estimates. So these two essentially cancel each other out, but that free cash flow increase is incredibly impressive. So that is definitely helping to drive their performance despite revenue being below estimates. And this is just some analyst commentary. So one thing I do want to point out is the target prices here. 249 for this company, or sorry, for that analyst, target 120 for this analyst, target 310, target 300. So that is something to consider when the stock price is at $470 a share, as we could see here. That is definitely something that you should be paying attention to. I do believe the company is overvalued. Obviously, they do have a lot of positive things to say about the company. Impressed with margins, notable price cuts. They did warn that quarter four will not be as strong as quarter three, which we'll have to see shortly. Other than that, optimistic forecast, still upside potential, which is interesting to see. So overall, the analysts do have a fairly good outlook for the company, but again, they do believe the company is overvalued. Now, one thing I'm going to say with Tesla is they have a very long term support line, which I believe is more their intrinsic value line, where as their sales have been exploding, as the company has been improving, they are definitely seeing a lot of growth. However, do I think that it deserves to be as high as it is right now? Not really. A lot of this recent growth comes from the election results, where Elon Musk is now very, very favorably perceived by the government. Obviously, with Donald Trump getting elected, they're two very close people with each other, and they will be working together as they have announced. So that is very, very positive for the company, which is showing this recent growth where they have seen going from basically $200. They have doubled in the past few months. So that is fantastic for the company. However, for their long term growth perspective, I do believe they will be dropping back down, most likely towards, if we go back here, most likely towards the $200 range. Now, I do believe it will take time to get down from the heights that they are at right now. So, if you bear with me zooming in here, I do believe that it will see some choppiness for the next couple weeks and then settle around the $200 range, hitting that support area somewhere around the second half of next year, possibly the beginning of next year. But overall, I believe it will see a decline in 2025 just because of how inflated the price is currently. But after that, it will find its intrinsic value and continue heading up from there. So overall, I think long term the outlook is positive, but short term it is very, very negative as they are just massively overinflated at the moment. So overall, that's all I have for Tesla. I hope you enjoyed, hope you learned something. Make sure to subscribe if you haven't, and I will see everybody in the next video. Thanks for watching.